Welcome to my channel. In this video, we are going to talk about what is stock market and how it works and what are the mythicalities spreading across the stock market. So one by one, we're gonna see how stock market works. The stock market is often called the heartbeat of the economy. It is a place where business raises money by selling shares to the public, and investors buy those shares hoping for growth and profit, and it is the long term process, and we can buy and sell. The Bombay Stock Exchange is the Asia's oldest stock exchange. It have around 5,000 plus stocks, and National Stock Exchange is the modern tech driven stock exchange. It is established in 1992 and it have around 3,000 stocks. Both NSE and BSE are controlled by SEBI. SEBI is the Stock Exchange Board of India. It controls overall the stock exchange, and the main motto. There are four basic steps are involved in the companies and investors for trading and investing the stocks and other investment strategies and the investment funds. The first one is the company raise the fund through an IPO. It means the initial public offering. Once the IPO is allotted, next the stock eligible for trading begins. Once the stock is listed in the exchange like NSE and BSE, then the stocks are we can buy and sold daily. Then latest price and also include in this stock exchanges. And price discovery is the third important. Price changes every second based on supply and demand. Once the stock exchange is entitled with the stock, and its price can change in the stock market field. When the stock market is established, until time across the world, there is lot of rumors and myths are spreading. So before starting an investor or a trader, they should know what are the myths are spreading and how can they overcome. So it is the first thing we need to know. The first myth: the stock market is a gambling. It is the every investors and traders says that the stock market is a gambling, but the real truth is the gambling it depends upon the luck. It come by only one based on your luck. In reality, the, the investing is the depends on research and discipline. So it's not come by the myth number two. You need lakhs to start. A lot of people thinking the stock market need to invest. We should have lot of money or in lakhs or crores. The reality is that we can start as a SIP or we can purchase a SIP or ETF that worth of minimum 100 rupees using our demat accounts and discounted brokers. The myth number three, the everybody knows the only expert can make money in the stock market, but it is the wrong statement. What is the reality? Even a business can win through the simple index fund through SIP, and he can wait in patience. Once he invests, he can wait in patience. He can also win in the stock market. So no need experience or the myth. The price moves randomly. So every investor says whenever they enter in the market, the stock prices are moves randomly. They unable to predict. So it is every investor facing a trader facing in the stock. The reality, the long term holding. Whenever we are holding the long term, it is only for the youngsters. Everybody says the market is getting too long, so we can't able to hold the money or we can't able to invest too long, and it says it only for youngsters. The youngsters can take money and invest in waiting for long time. The reality is Age is not the barrier. Only asset allocation and time horizon is the different. Whenever we enter in the stock market and we have so here are three stocks I have given for an example. The power of patience. So these stocks in the India they given massive returns to the investors for the over the long period. Whenever they hold the stocks from the beginning of the IPO till now, they get lot of dividends and a bonus, and there is the Infosys case study. The current price is in the 2025. It's 1,500 per share. The total value of shares they have 8,640 and thousand at the worth of 1,500. Now the current value is 12.1 crore. So it is the massive return to the Infosys IPO was started at 19 June 1993 at the share price 95 rupees per share. And you will get, if you invested through 10,000 rupees, you will get 105 shares. Over the decades, the Infosys has rewarded its early investors through multiple issues, bonus, stock splits, and consistent dividends. Every bonus issues multiplied shares counts while the company revenues, profits, and global footprint. Key lessons from the study: the compounding plus corporate actions gives exponential wealth. The time in the market beats timing the market. Patience and trust in quality business pay off over decades. If you had believed in Infosys Vision 1993, simply held your shares, your 10,000 would be have silently grown into multiple crores without trading, speculations, or luck. In the long term, conviction plus discipline, generational wealth, usually the Wipro case study. It is called the classic multi-bagger. The Wipro company started as a base company. It's a oil-based company. So later, how it's modified its business and how it's entered into the stock market and how the business gives massive growth and massive wealth to the investors. We can go through study in 1980, the Wipro was a small vegetable oil company called Western India Vegetable Products Limited. Under Asim Premji's leadership, it transformed into one of the India's largest IT and FMG groups. Over the past few decades, Wipro has issued multiple bonus shares and stock splits, turning those 100 shares into millions. So, it is the year of 1980, if you invested 10,000 rupees, you will get 100 shares per 100 rupees. By 2020, Wipro stock price hovered around 250 rupees to 300 per share. Total value of shares around 30 lakhs. You will get 75 crores plus dividend and split adjustments over 700 crores in 40 years. So you should wait. In this chapter, the compounding plus passions create extraordinary outcomes. Company's transformation can multiply wealth beyond expectation. Long-term faith in great management rewarded magnificently. One idea held with the conviction for a decades can change a family's financial future. So it is the key lesson from HDFC Bank, the steady compounder. From the HDFC Bank is the one of the leading largest banker in India. So this company is the one of the steady compounder in the investment who invest in the stocks for a decade. So this company gives huge and potential growth to the investors. So we're gonna study in this step. When HDFC Bank listed in 1995, India's private banking revolution was just beginning. Backed by Housing Development Finance corporations, it, it built its reputation on prudence, clean governance, and consistent growth. So, this concept gives more more revenue and growth to this company. The HDFC Bank IPO started in 1995, and over the, if you invested 10,000 rupees, you will get 250 shares along 40 rupees per share. In this over the decade, the HDFC banks give, delivered exceptional compounding returns through the steady profit growth and multiple stocks. Currently, you have a total value 5,000 shares you should have, and 1,500 worth you will get 70 lakhs plus. Key lessons from this HDFC Bank: consistency beats the volatility. Even the modest compounding at 20% per year creates huge wealth over 30 years. Quality management plus steady profits equal long-term trust. You don't need lottery stocks. HDFC Bank proves that slow, steady, and disciplined investing is the real fast and learn to wealth. From this video, we had seen some mythicals and some case studies. For an example, it will give full overview to how a beginner and how an investor keep selecting stocks and holding his investment along how many years. So this will be more helpful to him to keep growing his growth and investment journey. And best of luck to all, and keep